Hello, everyone. A warm good evening to everybody. I am C. Elina Vamnahar, moderator for this webinar. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be a moderator for this session on transactions in immovable property under FEMA and taxation of stock market transaction. In a short while, we will start this webinar. I would like to apprise you about CP committee first. The role of a chartered accountant is evolving continuously to accept newer responsibilities in a dynamic global environment. Therefore, the need of the hour is to innovate as per the requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. The CP committee believes that members of ICA should look beyond the traditional areas of practice and seek to explore new areas of business and profession. And hence, the CP committee is mentoring the members by providing guidance through various workshops, seminars, national conferences, background material. We are pleased to inform you that ICA is organizing its first ever Global Professional Accountants Convention, that is GLOPAC, on the theme Connecting the Globe, Creating Value from November 24 to 26, 2023 at Mahatma Mandir Convention Center, Gandhinagar, Gujarat. GLOPAC is being celebrated as a mega event to display the important role that the accountancy profession has been playing in building stronger and more stable economies around the globe. It would provide an opportunity to the global market to network with the best F&A talents in India. I would request our technical team to play a teaser on this. So, requesting team to please play the teaser.
It gives me immense pleasure to announce that the Institute of Chartered Accountants of India has decided to organize its first ever Global Professional Accountants Convention, GLOPAC, on the theme Connecting the Globe, Creating Value on November 24th to 26th, 2023 at the Mahatma Mandir, Gandhinagar in India. GLOPAC is being celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of our country.
Globalization has made the world one village, and the services of chartered accountant are also available globally without any boundaries. The Institute of Chartered Accountants of India is also devoting significant efforts towards global networking. The convention shall be attended by more than 3,000 delegates from around 40 countries. I would like to extend a warm welcome to the fraternity on behalf of ICI to attend and participate in the first ever GLOPAC.
ICAI is geared up to welcome delegates from across the globe at the GLOPAC.
All right. So now let's start for our today's session. We have a wonderful program today evening where we have two sessions of 1 hour each, and the topics are very important. That is acquisition and transfer of immovable property under FEMA by CA Pooja Desai ma'am and the tax treatment on stock market transaction. That will be the second session, which will be conducted and moderated by Bhumika ma'am. And the renowned speaker is CA Jignesh Ji Parak. CA Jignesh Ji Parik. Our eminent speakers will talk about two mentioned topics emerging in the areas of professional interest. And now we are very fortunate and lucky enough that we have the two best speakers. Along with that, we have our chairperson and vice chairperson, that is chairman and vice chairman for the event. So I welcome you, CA Purushottam Khandelwal ji, who is the chairman for CPEC. Hello, can you hear? Can you hear now?
Yes, yes,
Yeah.
now perfect.
So at the outset, I welcome CA Purushottam Khandelwal ji, who is the chairman of CPEC, and very happy that recently we have joined our vice chairman, that is CA Gyan Chandra Mishra ji. So I welcome you all on behalf of ICAI. Here I would like to give a brief introduction about our vice chairman, first of all, who will be guiding us. So let me give you the formal protocol. Everybody knows who is Gyan Chandra Mishra ji, but as a protocol, I would like to give a brief introduction. CA Gyan Chandra Mishra is chairman of CP Committee and chairman of Committee on Insolvency and Bankruptcy of ICAI. Presently, he is serving the Institute of Chartered Accountants of India as a Central Council member and convener, Tender Monitoring Directorate of ICAI. He has more than 24 years of professional standing to his credit as an established chartered accountant. That's a long period. Under his vision, this year's CPE committee taking new initiatives for the member. So with this brief introduction, I request CA Gyan Chandra Mishra ji to please take over and give the opening remarks for all our attendees who is attending our today's webinar. Over to you, sir.
Oh, thank you, moderator of the program, and of course, very distinguished chairman of the committee, CA Purushottam Khandelwal bhai, two very distinguished speakers, Madam Pooja Desai and CA Jignesh Parik ji, two very wonderful moderators, Leena madam and Bhumika madam, and of course, secretary of the committees, Ajit bhai, and very importantly, all the respected participants. Good afternoon to one and all. Friends, we all know that CP committee has an endeavor that we have every Wednesday 2 hours e-learning program. This is virtual learning, and the topics being chosen are very wisely been undertaken, because the sphere of the professionals are multidimensional. So today's program is as well of the same. By Pooja Madam, acquisition and transfer of immovable property under FEMA, and by Jignesh ji, tax treatment of stock market transactions, which is really tedious. So friends, enjoy the wonderful sessions by both the speakers, and my good wishes to one and all for happy learning. Thank you very much.
Yes, thank you, sir. Thank you so much for your wonderful words. Now I request our chairman for the committee, first of all, would like to give a small introduction for him. Basically, the unofficial introduction I may give, that a very smiling person, CA Purushottam Khandelwal ji, who is a chairman of CPEC, that is vice chairman at CMP and Career Counseling Committee of ICAI, also deputy convener of UDIN Directorate. He is having 25 years post-qualification experience in the field of audit, direct and indirect tax, and intellectual property rights. This year, he is devoted to fortifying CP framework and guaranteeing quality across its entire operational spectrum. And this year, major focus would be on upgrading of CP portal and mobile app for enhancement of the branding and professional competency of members. So everything is going with the digitalization, and definitely ICAI should also go ahead with this. So we have the CA Purushottam Khandelwal ji. I welcome you all, sir, on behalf of ICAI. I request you to please give your opening remarks for the session. Requesting Purushottam Khandelwal, sir, over to you.
Good afternoon. Vice Chairman of this committee, Gyan Chandra Mishra ji, faculty Pooja Desai ji and Jignesh Parik, two moderators, Leena Madam and Bhumika ji, of course, secretary of this committee and architect of this program, Ajit Tiwari ji. It gives immense pleasure to be amongst you that the CP committee is a mother committee of all the committee. And this year, we have dedicated every Wednesday for the learning day. And a line of this, we are organizing a program on which is very relevant for the professional. And after the feedback received from member wants this kind of program, so we are keeping this program on every Wednesday. This year, we have changed a lot of in the CP committee. So this year, the 3-year rolling period is no more there. So you have to do the CP requirement this calendar year only. So 20 structure hour you have to complete it within this calendar year. 4 has to do from the audit and another for the hello. This 4 hour has to be compulsory. Have to do the programs. So I will not much take the time. This is a very, very important time because already we have passed the time. I request moderator to go ahead. Pooja madam is there. She's very learned in the FEMA. So please start the seminar. Thank you. Thank you so much.
Yeah. Thank you, sir. Thank you so much. So now here we will start for our today by CA Pooja Desai ma'am. Ma'am will definitely start and will highlight her experience on the topic of acquisition and transfer of immovable property under FEMA. But before that, let me give you a small introduction of Pooja ma'am. Various degrees such as BCom, yes, she's also pursuing FCA. That's wonderful. She's practicing since last 10 years, areas of practice, cross-border advisory services, direct tax laws, FEMA, international taxes, and many more things. She's also associated as director in MNCs and involved in USA business, establishment by way of startup or acquisition. She has also delivered lectures in various institutions on various topics. So today it's a privilege to have Pooja ma'am with us, who will guide. We'll start for the session. Over to you, Pooja ma'am.
Thank you so much. Thank you so much for the great words. And I express my sincere thanks to the CP committee for giving me such a wonderful opportunity to present my thoughts on this subject. So let me share my screen first of all. Just a minute. Can you see my screen?
No, ma'am, not yet.
I don't know. Just a minute. Perfect. Now it's visible.
Yes, ma'am.
Perfect.
Yeah, it
So,
is.
yeah. So today's topic is acquisition of immovable property in India and outside India. We will talk for this topic about under the FEMA provision. Before going to the regulation, let me give you the object why this regulation has been came, right? So for any regulation, there is one object. Our main object for this regulation is to balance the economy. Many a times what happens that there might be a non-resident group having a great financial strength or financial power. They might acquire a great or a large amount of land in India. And due to that, it will unbalance our economy. And therefore, to balance the economy of our country, it is very important to bring the regulation, and that's why this regulation has been came. So what is the background? So friends, FEMA roams around 3 aspects. Who is the person? What is the activity? And transactions are capital account transactions and current account transactions. If there are current account transactions, it falls under the automatic route. And if it is a capital account transaction, we have to take a permission of RBI. Now, immovable property. Dealing with immovable property is fall under the capital account transaction. And therefore, there were notification number 21, which was replaced by notification number 21R dated 26th March 2018. Friends, notification number 21R has been replaced by Non-Debt Instrument Rules 2019 dated 17th October 2019. 21R and non-debt instrument rules are almost at par. There are no major changes. But notification number 21 and non-debt instrument rules have substantial changes. In non-debt instrument rules, PIO, that means person of Indian origin, concept has been demolished. So from now, PIO considered as an OCI, and this regulation talks about NRI and OCI. Friends, earlier FEMA was introduced in 1999. It is a replacement of FERA Act. FERA was roaming around the concept of citizenship, but FEMA does not, right? But friends, this specific regulation roams around the concept of citizenship. Now, immovable property transactions across the border are capital account transactions. Let us understand what is the meaning of capital account transaction. So, the capital account transactions which alter the asset or liability, including contingent liabilities outside India of person resident in India, or alter the assets or liabilities in India of person resident outside India. Friends, there are two kinds of immovable property transaction. One, there is a business transaction, and another is a personal use transaction. Business transaction is covered under FDI, that means real estate development activity, for which we are not going to discuss in this presentation. We are going to discuss about the immovable property transaction deals with personal use. Now, this presentation deals with two aspects: non-residence transactions for immovable property in India, which is covered by NDI rules 2019. And the other is Indian residence transaction for immovable property outside India, which is deal with OI rules 2022. Now, friends, what is the meaning of immovable property? So, immovable property is not defined anywhere. So, we have to take a general meaning of immovable property. It should include all type of immovable property, that is residential, commercial, industrial, agricultural property, even we can say underdeveloped property. So, all kind of property fall under the immovable property. What is the meaning of NRI, OCI, and foreign national? Before go to the in-depth of the provision of this regulation, it is very important to understand the definition of NRI, OCI, and foreign national. NRI means a citizen of India who is a resident outside India, right? Means a person who born in India, but now he resides outside India. For example, in US, he called as a non-resident Indian. Overseas citizen of India means an individual resident outside India who is registered as an overseas citizen of India under Citizenship Act. Means a person who is residing US right now, he may apply for OCI registration in India. At that time, that person can say overseas citizen of India. Foreign national means a person is a foreign national to India who lives outside India and not a citizen of India. So friends, let's discuss about the first part, that is immovable property in India by person resident outside India. The overview of this regulation under the NDI rules are as under: acquisition of immovable property by NRI or OCI, repatriation of sale proceeds of immovable property, joint acquisition by spouse of NRI or OCI, even if spouse is non-resident or not NRI or OCI. Then acquisition of immovable property for carrying a permitted activity or a business in India. Acquisition of immovable property by long-term visa holder. There are certain citizens which are prohibited. We will talk about that. Purchase and sale of immovable property by foreign embassy, and mortgage of immovable property and loan. So these points are covered under these regulations. So friends, let's discuss what non-resident cannot do and what can do. So non-residents are primarily barred from acquiring immovable property in India. However, NRI and OCI can acquire property for holding or self-use. They can sell property and repatriate the sale proceeds abroad most of the times. They can also let out the property on rent and repatriate the funds abroad after payment of taxes and bequeath the property to anyone. So in nutshell, NRI and OCI can do everything. What NRI and OCI cannot do? NRI and OCI cannot buy agricultural land, plantation property, and farmhouses. Even NRI and OCI cannot do real estate trading or trade in transferable development right. Now, friends, there is no clearly anywhere written that NRI and OCI cannot do real estate trading. In FDI guidelines, it is written that NRI and OCI cannot invest in an entity who is dealing with real estate trading activity, right? But it is not clearly anywhere mentioned that NRI and OCI cannot do real estate trading. But this is an understanding. In FEMA, what we cannot do directly, we can't do indirectly. And therefore, NRI and OCI cannot do real estate trading activities. And friends, there are the difference between real estate trading and real estate development. In general parlance, real estate trading means buying and selling of the land. Whereas in case of real estate development, we have a project of development. So real estate development is a permissible activity under FEMA, whereas real estate trading is not permissible. Now, acquisition of immovable property by NRI and OCI. There are three ways to acquire the property by NRI and OCI. Those three ways are purchase, gift, and inheritance. So we will discuss about all these provisions. After acquiring the property, NRI and OCI may like to transfer the property. After transferring the property, they receive the proceeds and they may like to repatriate the proceeds. So we will discuss each and every provisions, what NRI and OCI can do and what they cannot do. Now, NRI and OCI, they can acquire immovable property, except agricultural property, plantation, and farmhouse, as discussed. They can make payment for purchase from abroad only through banking channels or from Indian account only. No other account No other mode is permissible. The second way, so purchase is a very simple. NRA OCI can purchase immovable property except agricultural property, plantation and farmhouse. Payment should be from the banking channel. Now, gift. NRI and OCI can acquire property by way of gift only from a relative defined in a Companies Act 2013. This is a very small definition in the Companies Act 2013 for relative, but they can receive the gift from the relative only. Friends, here we have to take care that acquisition should be at the point of acquirer's point of view. We have to see. Let me give you one example that father-in-law can receive the gift from daughter-in-law because it is under the definition of relative. But daughter-in-law cannot receive the gift from the father-in-law because husband's father does not fall under the definition of relative. So we have to take care while looking at the relative definition and acquirer's point of view, we have to check whether he or she is a relative or not. Acquisition can be from a resident, NRI or OCI, but not from anyone else. Friends, earlier in erstwhile notification number 21, there was a provision that you can acquire immovable property from non-relative also. But now in notification number 21R and NBI rules, this relative definition has been inserted, relative provision has been inserted, and therefore we can accept, NRI and OCI can accept the gift only from relative. Now, after acquiring the property, they may like to transfer the immovable property without any approval, right? So they can transfer the immovable property without any approval except as under. Non-agriculture property. If the property is non-agriculture, then it can be sold or gifted away to Indian resident, NRI and OCI. Of course, not to the foreigners who are non-residents. And if it is an agricultural property, it can be sold or gifted only to the Indian residents. So transfer is possible. Now, after transfer, they may like to repatriate the sale proceeds. So NRI and OCI, subject to the guidelines, funds can be repatriated abroad without any approval. Now, when the repatriation is possible, if the property was purchased in foreign exchange, then sale proceed can be repatriated. In erstwhile notification number 21, there was a clause that you can repatriate the amount up to the cost of the property. But now that has been removed, so you can remit the fund equivalent to your sale proceeds. Then property should not be the agricultural property. This is the obvious conditional. The third one is repatriation is restricted to 2 house property in case of a residential house. Friends, for commercial house or commercial properties, there is no restriction. But for residential house, the limit is 2 house for immovable property. Now, the question arises, this 2 house limit is for which period? For one financial year, or at a time you should have 2 property, or for a lifetime period. So friends, this 2 house properties limit is for lifetime period. You can remit the fund, for only 2 house properties in case of a residential house during the lifetime. Now, what if the investment is non-repatriable? In case of non-repatriable investment, up to $1 million scheme, you can repatriate the fund every financial year. This limit is inclusive of all purpose. In this 1 million USD scheme, it includes for immovable property, for shares, for other assets, everything. So this is an inclusive for all the purpose. Now, this is the third way to acquire the property. So NRI and OCI can acquire the property by way of inheritance. An NRI can acquire property through inheritance from non-resident if he had acquired immovable property as per then prevailing law, and from the Indian resident. So friend, this phrase, if he had acquired immovable property as per then prevailing law, should for both the sentence from non-resident and from Indian resident. Right? So here, let me give you one example. If a non-resident has purchased the property not as per the FEMA provision, now he is becoming Indian resident. What if NRI can acquire the property through that Indian resident? That is the question. In that case, it will create a great problem to the buyer. But if buyer is not aware about any fraudulent activity done by the seller, then what? If buyer is not aware about, so the due diligence is the responsibility of the buyer. If he does the due diligence in a proper manner, then it is okay. But if he hasn't done any due diligence and he buys the property which the seller had not acquired as per the prevailing law, this will keep him in a trouble. So we have to be very careful by acquiring the property in any means of mode. And NRI can bequeath the property in his will to another non-resident or non-resident. Even an Indian resident can also bequeath property to the non-resident. So in nutshell, bequeath to non-resident or Indian resident, that is permissible. Even agricultural land can be bequeathed or inherited. However, there are some restrictions on repatriation. So what are the restrictions? That after getting the agricultural land in inheritance, NRI cannot do any agricultural activity. That is clearly mentioned in the regulation. But many times what happens that because of unaware about the law or unawareness about the regulation, these rules has been broken. So after getting the property, NRI used to do agricultural activity regularly, but as per regulation, it is prohibited. Bequeath IP to non-resident. So immovable property in India can be bequeathed to non-resident. Yes, immovable property in India can be bequeathed to non-resident. So many times what happens that Indian parents, rather than bequeath it to their immovable property to non-resident heir, they may like to gift before their death. So is it permissible? Can it be distributed before death? Yes, Indian resident relative can gift the immovable property to NRI and OCI. In that case, LRS limit does not apply. You can give, for example, 3 or 5 crore property to your relative without any LRS limit. But friends, Indian residents should not buy and give to the NRI or OCI. One should not do the things indirectly which cannot done directly. So many times what happens that Indian parents say, I have a 4 kid, right? As of now I have a 2 property. I want to gift my all kid 1111 property. So I'll buy another 2 property and gift it them. Is this permissible? No, you cannot buy and gift to your son. You can buy the property, can hold for 6 years, 7 years as permissible, and then you can gift it to your legal heir. Without, you cannot simply buy and give to your legal heir. So we have to be very careful while doing any transaction of gift. Now, inheritance by non-NRIs, what if they want to repatriate the fund? Non-NRI who is a foreign citizen require approval to inherit immovable property and hold the same. So non-NRI, that means a foreign person or a foreign trust. If foreign trust receives any immovable property in inheritance, to hold the same, they need approval from the RBI. Many times what happens that in case of inheritance, we feel this is our right to get property and therefore there is no requirement of approval. But if non-NRI receive any property by way of inheritance and to hold the same, they need prior approval. And no approval is required to transfer to Indian residents. Friends, if the NRI and OCI who received the property by way of inheritance, now they want to sell the property. Can they sell the property? Yes, they can sell the property to Indian residents. There is no prohibition or there is no approval route for the sale of the immovable property. But there is one condition. The resident otherwise should be eligible to purchase. He should not be the citizen of 11 countries. Now, these 11 countries like Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Hong Kong, Macau, Nepal, Bhutan, and North Korea. These 11 countries' citizens are prohibited to buy any property in India. So NRI and OCI cannot sell to a person who is a citizen of these 11 countries. Now, a person, now after selling the property, they may like to repatriate the fund. Now, NRI and OCI can repatriate the fund up to 1 million USD scheme without approval or without approval of RBI. But now this 1 million US dollar scheme is inclusive. This includes all assets, shares, and other movable, all kind of assets is included here. Now, for immovable property, one need approval for repatriation. Though it included in $1 million scheme, but immovable property approval is required. However, if inheritance is from a resident under Section 6(5), then $1 million scheme is available. So friends, 6(5) is talking about that non-resident had acquired a property while he was a resident in India, then he can continue to hold or sell the property. In that case, $1 million scheme is applicable and he can repatriate the fund under $1 million scheme. Friends, this is a tricky steps, but if you follow step by step, it will be easier for you. Can NRI and OCI take a loan for immovable property? Yes, NRI and OCI can take a loan from Indian banks. or financial institutions and employers. Earlier, in erstwhile notification number 21, there was a AP circular where all the conditions regarding the loan has been mentioned, and it was easier for the client to follow all the conditions. But in the amended NDI rules, the conditions for the loan has not been prescribed. So in practical case, it is very difficult for NRI and OCI to get a loan from the bank. If they have taken a loan, can they make repayment of loan from NRI and foreign fund accounts? Yes. Repayment of loan can be made from NRI account, foreign fund account, or NRO account. If they have made payment from NRI account and foreign fund account, then the repatriation, then the funds are eligible for repatriation. Earlier, there was in erstwhile notification number 21, there was a condition. Then loan installment can be paid from a relative. But now, in NDI rules, it is clearly mentioned that loan payment can be made by NRI or OCI himself or herself. Relative cannot make payment of loan now onwards. Renting of immovable property. NRI and OCI can put property on a rent, so leasing is permissible, and rent can be repatriated. As rent is a current account transaction, it is repatriated. It is simple. Now, friends, let's see acquisition of immovable property by person other than NRI and OCI. So, foreign citizen who is a resident of India, can they buy immovable property? Yes, Indian resident can buy immovable property without any approval, because FEMA does not apply to Indian resident. FEMA applies only to the non-residents. Now, there is a restriction on citizen of 11 countries on acquisition of property. So 11 country citizens cannot acquire immovable property in India. To digest this fact, let me give you one simple example. There is a German employee who is coming to India for the employment purpose. As per the FEMA, the moment he comes to India for employment purpose, he becomes resident of India. Now, he is a German citizen residing in India for employment purpose. He is a resident of India. He can buy immovable property without any approval, because now being Indian resident, FEMA doesn't apply to him. Now, what happens if Hong Kong citizen comes for employment in India? Even though being an Indian resident, Hong Kong citizen cannot buy immovable property because restriction is there on 11 countries. Hong Kong is fall under that 11 countries, and therefore any citizen from then 11 countries cannot buy immovable property in India. Friends, OCI can buy property in India even though they are citizen of this 11 country. Then they fall under this normal provision of NRI and OCI, and they can buy the property. So OCI can buy the property in India even though they are a citizen of 11 countries. Now, after receiving the property, they may like to transfer the property. So can they transfer the property? Yes, foreign citizens who are the Indian resident can transfer the property to any Indian resident without any approval. But what happens if they become non-resident later? German employee go back to his country and become non-resident, right? In that case, he can sell to the property to Indian resident. For that, no approval is required. But he cannot sell to the person or a citizen who is a citizen of 11 countries. Transaction should be through banking channel. That is the obvious condition that will come in all the regulation and rules. Now, repatriation of fund. What if that German employee is an Indian resident? Then he can remit the fund under the LRS scheme. What if he becomes the non-resident? After becoming non-resident, they can sell the immovable property as per section 6.5, which we have discussed earlier. And therefore, repatriation of fund is possible, but for that, approval is required. So this was the provision regarding the NRI and OCI, and other than NRI and OCI for purchasing immovable property in India. There are some specific provisions related to the immovable property. In that, first is non-NRI and OCI spouse. A person resident outside India who is a non-NRI OCI, who is a spouse of NRI and OCI, can acquire one property in India. Friends, here it is to be remembered that a person who is a spouse of a NRI and OCI can acquire one property in India. What if Indian resident has a spouse who is a non-NRI and OCI? So it is nowhere mentioned, and therefore spouse who is a non-NRI OCI, spouse of an Indian resident, cannot buy property in India. Property to be jointly held by NRI and OCI spouse. Now friends, payment. Payment should be in the foreign exchange or through banking channels or permitted account transactions. There is one condition for this regulation, that marriage has been registered and subsist for a continuous period of 2 years. Only then the person is eligible to buy property. Otherwise, person is not eligible to buy the property. And the person is otherwise not prohibited. That means that 11 country citizens cannot buy property in India. Long-term visa holder. A person being a citizen of Afghanistan, Bangladesh, and Pakistan, belonging to the minority community, can buy one property for residential purpose and one property for self-use purpose, self-employment purpose, subject to the following conditions. So we don't go into the depth of the conditions, but we have to follow the condition, and subject to the condition, one can buy property for one for residential purpose and the another for self-employment purpose. Now the question arises that a citizen who is citizen of Afghanistan, Bangladesh, and Pakistan residing in India, and for Indian resident, FEMA doesn't apply, then then where is the restriction, right? But this is the ultra-virus provision. So whenever a person who is a citizen of Afghanistan, Bangladesh, and Pakistan wants to buy a property, they have to check the visa rules first, and then only they can buy the property, unless and otherwise they are prohibited to buy. at the time of sale of property, the person should have acquired the citizenship. Otherwise, they have to take approval of DCP, FRO or FRRO as the concerned authority. Now, till now, we discussed about the immovable property acquired by for the personal use. Now, immovable property for business, that is branch. So, non-resident who set up a branch or place of a business in India can buy immovable property, which is very necessary and incidental to carrying out activities. However, entities of 11 countries referred to earlier require prior approval. License office cannot buy immovable property. So friends, let me give you one example over here that Hong Kong citizen, right? They want to set up a branch in India. Can they set up a branch in India and buy immovable property? No. Hong Kong citizen cannot he may set up a branch by taking approval, but he cannot buy immovable property in India. So many a times what happened to buy immovable property, Hong Kong citizen or Hong Kong company may set up a subsidiary company in Singapore, right? And Singapore company sets up a branch in India and that branch buys the property in India. Is it permissible? So as discussed earlier, in FEMA, what you cannot do directly, you cannot do indirectly. You cannot choose a way to buy a property by setting up a subsidiary in Singapore. Now, let me give you another example that Hong Kong citizen having a majority shares in Singapore company. And Singapore company is a listed company. Singapore company has many employees and business activity in the Singapore, and they have a economic reason to set up a branch in India. Now, Indian branch is buying immovable property. So is it permissible? So yes, you have to check the economic substance. So this is case-to-case basis, and you have to check all the facts, and accordingly, you can advise your client. So we have to check the facts of the case, economic substance, and the activities. A declaration has to be filed within 90 days in the form. Mortgage of property can be done for taking a loan from a Bank of India. For sale, RBI approval is required. So if branch wants to sell the property, RBI approval is must. NRI and OCI card holder are permitted to invest under Schedule 4 of the FEMA notification to invest on non-repatriable basis. Investment can be done for earning lease income. So friends, in FDI policy in construction sector, it is mentioned that leasing is permissible. So one can take a view that you can construct the property and then only you can lease the property. But you cannot buy the property and lease it out, right? But in Schedule 4 of the FEMA notification, it is clearly mentioned that NRI or OCI cardholder are permitted to invest in the immovable property and they can lease it out. So with this Schedule 4 of the provision, NRI and OCI can lease out the property. Foreign embassy, it is more of the theoretical subject. they can buy the NRI and OCI can buy the property in India subject to the following conditions. This is for the foreign embassy. They have to take a clearance from a government of India, Ministry of Affairs. The consideration for acquisition of immovable property in India is paid out of the banking channel. So this is more of a theoretical use. Now, friends, lease of a property. Acquiring property by non-resident by way of a lease up to 5 years, it is permissible. Even license office of a foreign company can acquire property by this route. And it is not a capital account transaction. So whenever you acquire a property up to 5 years, it is considered as a current account transaction and it is permissible. Even 11 country citizen can acquire this route to buy a property. Now, what happens that if foreign person wants to buy a property in India, simply they buy a property by lease this way, by taking a property on a lease for 5 years. Is it permissible? So yes, under FEMA, foreign person can buy a property in India for a lease. But while buying the property, you have to check out the other provision also. When a person resident outside India buys a property in India for a lease, it creates its place of business. And accordingly, it creates a business place. And therefore, this route is advisable when one wants to do business activity only. For personal use, this regulation doesn't help out. So friends, Lina ji, can I continue this presentation because it's 4 p.m.
Yeah, ma'am, I think couple of minutes we can continue. We have few questions also for you.
Sure. Perfect. So I'll try to finish as soon as possible.
Yes.
Perfect. Yeah. So this is the second part, that immovable property outside India by resident in India. This regulation is covered by OI rules, and there are few ways to acquire immovable property outside India. One can acquire property by way of inheritance. The other way is purchase out of a foreign exchange held in a RFC account. Now, what is the RFC account? RFC account is generally meant for returning Indian who has some commitment overseas, and for that they are maintaining RFC account. Purchase out of LRS remittance. So from LRS, definitely you can buy property jointly with a relative who is a person resident outside India, and out of income or sale proceeds of the asset other than ODI, you can acquire the property outside India. There are two exceptions, that foreign nationals are exempt from the regulation. This is obvious. Foreign national can buy property outside India anytime, anywhere. Immovable property acquired on or before in July 1947 and continued to be held with the RBI approval, and this regulation is not applicable. So these hardly happen, but in that case, this regulation doesn't apply. Property acquired by a person in India on a lease or less than 5 years, in that case, it considered as a current account transaction and not a capital account transaction, and therefore this provision doesn't apply. So friends, purchase is permissible under LRS. LRS limit is $250,000. Lease is also permitted. Sale is also permitted. After sale, you received proceeds. So you can retain the fund outside India, that is also permitted, and you can also reinvest those funds. But at the time of reinvest, you have to check the master direction of LRS, what is permissible activity and what is not. Accordingly, you can reinvest those funds. So now, an individual can remit money under LRS in foreign bank and buy immovable property when sufficient funds are available. So let me give you one example that property value equivalent to $400,000, but the limit is only $250,000, right? So what you can do, you can remit $250,000 1 year and remaining fund to the next year, and then you can buy the property. Otherwise, you can buy a property in joint family name. For example, Mr. A is remitting $250,000 and Mrs. A is remitting the remaining fund. But friends, be very careful. When you buy a property in joint name, then your ownership ratio in the property should be same as per the ratio you remit the fund. It should not be unequal, right? Now, one cannot take a loan in India or abroad to buy a property. So for buying immovable property, you cannot take a loan. For taking a loan, you need to take prior RBI approval. And in master direction of LRS, it is also mentioned that it should be your own fund. It should be not your borrowed fund. So you cannot take a loan. Now, a branch of an Indian company can buy immovable property for business or staff residence as per the regulations. So this is very simple. Under FEMA notification 120, foreign company buys immovable property for its own use, it is permitted. So when a entity opens a company outside India, that means a foreign company, when it buys immovable property for own use, it is permitted, but it should be commensurate with your business. So when you do a nominal $100 activity of your business and you buy a 1 billion house, that doesn't match with your activities, then it is not permissible. But if you are doing a measurable activity which can be demonstrated, then accordingly you can buy immovable property. Now, if Indian entity has a subsidiary or wholly owned subsidiary outside India, so many times what happens that in case of pharma clients or hotel clients, they used to invest money in one entity for building, for construction of building or purchasing immovable property, and investing in other entity as an operating entity. So they have a two entity, one entity for immovable property and the other entity is for operating business. Can one entity lease out property to another entity? That is the question. Now, as per the rules and regulations, if you construct the property, then you can give it on a rent or lease, it is permissible. But by simply you buy the property and give on a rent, this is not permissible. Indian resident cannot acquire immovable property as a remuneration for service rendered. For that, you require RBI approval. So we are done with the rules and regulations. Now I have given simple one case study and 3 posers. Shall I go, Lina ma'am?
Yes, ma'am. Couple of minutes we
Okay.
can spare.
Perfect.
Yeah, a few questions too.
Okay, perfect. So let me give you one case study. Mr. Sukhvinder, who was residing in India, okay, and he has a son Balbir, daughter-in-law, and grandson living in Canada. Sukhvinder has purchased, he is an agriculturist. He has purchased 100-acre land, 5 farmhouses in India. He also acquired few shops, and few shops has been given on rent, fetching a good rent. He has negotiated a deal to buy 10 acres land from an agricultural land in his place, and he has given a token amount as well, right? He would like to spend his balanced life with his son in Canada. Now he decided to migrate. Now our question is, before leaving India, whether he should do anything about his property in India? Can he hold this property and continue to earn the rent and reinvest money in other assets? Yes. As per section 6.5, a person resident outside India may hold, own, transfer, or invest in any immovable property situated in India if such property was acquired, held, or owned by such person when he was resident in India, or inherited from a person who is resident in India. So, as per section 6.5, Mr. Sukhvinder can hold detailed property which he has bought when he was resident in India. Once he starts living with his son in Canada, can he sell his property and repatriate the money to the Canada? Yes. As per the 1 million USD scheme, he can remit the fund to the Canada. Now, the third question is, he has already given a token of a proposed deal to buy 10 acres of agricultural land and given a power of attorney to his nephew to complete the registration in the month of 2022. Any issue about it? So, being a non-resident, he cannot buy agricultural land in India. So there is restriction to buy agricultural land, even though he has given a power of attorney to his nephew, as the ownership has not been transferred before he left his country, he cannot do this deal. So the person cannot buy agricultural land in India being a non-resident. Now there is a poser one, that Mr. A, who is a person resident in India, wants to buy a property of $600,000 US. Mr. A can remit $250,000 under LRS. Mrs. A will remit $250,000 LRS. Now, for $100,000, he wants to obtain a loan from Indian branch of SBI. Is it possible? So friends, this for the transaction, $100,000 is a liability, and any contingent liability called as a capital account transaction. And for any capital account transaction, we need a prior approval of RBI, and therefore this transaction is not permissible. What would be the position if Mr. A wants to remit $1 lakh from the account of his minor child by giving him a loan? Is it permitted to do so? So, if Mr. A gives $100,000 as a loan to his minor child, and if minor child gives $100,000 for this transaction, then it is considered as not permissible transaction, because here the word used loan, right? Here the word used loan, and loan creates liability, and even in master direction of LRS, it is mentioned that the fund should be your own fund. So minor child's fund should be his own fund and not borrowed fund. So it is not permissible. But yes, if Mr. A would have given a gift to his kid, minor kid, then it should consider as his own fund and he can definitely use this money to buy a property outside India. Proposal number 2, can an NRI repatriate the sale proceeds from 3 residential property and 3 commercial property in one financial year and sale proceed of the 3rd residential property in the next financial year without obtaining RBI approval? So friends, as we discussed in our presentation, that for commercial properties, there is no restriction. You can remit the fund without any restriction, but for residential house, 2 houses limit is for lifetime and not for financial year. And therefore, you cannot remit the fund for 3rd home without obtaining prior approval. The 3rd poser is Mr. A, who is a person resident in India, had acquired a property situated in UK by way of gift from Mr. B, who is also a person resident in India. But Mr. B had acquired the property when he was a person resident outside India. Now, Mr. A wants to sell the property in UK. Is it permissible transaction? So in that case, we have to check whether Mr. B has a purchased property as per their prevailing law. If yes, Mr. A can sell the property. If not, then he has to comply all the provisions before selling the property and then only he can sell the property. Thank you so much. Thank you so much.
Yes, done, Pooja ma'am. You completed it.
Yes, I've done it. I did it. Thank you so much.
Yes, it's wonderful. It's wonderful to hear you. Basically, the topic
Thank
and the
you so
subject
much.
is too vast. The subject and topic is too vast. It's very difficult to cover in given time, but I think you tried your best. And I believe
Yes.
all our participants who attended it cleared so many doubts and got the wonderful guidance from you. I think we have few questions, ma'am. If you allow, can we take few
Okay.
questions?
Definitely.
Yeah. Ma'am, we got the first question from our one participant that if foreign national gives flat to Indian resident who is a non-relative, then what is the procedure for it? Can you hear, ma'am?
Yes, please, can you?
Ma'am, I think your mic is mute. Yeah.
Yeah.
Shall I repeat it?
Yes.
Okay. I repeat, ma'am, the question is, if foreign national gives flat to Indian resident who is non-relative, then what is the procedure for it?
First of all, foreign national, by which mode he is giving flat to the Indian resident?
I think that needs to be clarified.
If it is by way of a gift, it is permissible. There is no issue in that. Unless and otherwise,
Okay.
we have to, we have to check the fact of the case, and accordingly we can answer. But definitely, by way of gift, an Indian person can receive a gift from a foreign nation.
Okay, all right. Thank you, ma'am. We have one more question that whether OCI can inherit IP from resident without approval?
OCI can inherit movable property
from resident without approval?
Yes. NRI and OCI can get property by way of inheritance. Rather, inheritance is only way to get a property for NRI and OCI. Right?
Okay.
And otherwise they can.
Okay, so without approval, they can take it, right?
Yes.
Okay, ma'am. We have one more question, ma'am. Can Indian citizen acquire immovable property outside India without prior approval of government?
Yes, they can definitely acquire the property. The by way of means we discussed. First is the LRS, by way of LRS, we can acquire the property outside India, and there are other 3-4 conditions from RSP account and from other conditions we can buy a property outside India. There is no buying that, but LRS limit should be followed. That is $250,000 per year per person.
Okay, wonderful. We have one more question, ma'am. Please explain from the perspective of tax implication. That was the question, but I believe you covered the LRS perspective. We'll move to the next question. NRI and OCI spouse can acquire property as a legal inheritance?
NRI and OCI spouse, now we have covered a specific provision that an NRI and OCI spouse who is a non-NRI, even who is a non-NRI, can acquire property in India. There is a specific condition that your marriage will be persistent and everything, but yes, spouse of NRI and OCI can acquire property in India.
Okay, wonderful, ma'am. Ma'am, we have the last question. Resident owning agri property becomes citizen of another country. Can he continue to hold it, or can he form a trust and transfer to a trust where he is also a trustee?
See, he can continue to hold the agricultural land. As per section 6.5, if a person resident in India now becoming non-resident, he can acquire, hold, or invest or sell that asset which he has owned at the time of Indian residence. So he can acquire and hold the asset. There is no requirement to transfer the asset by creating trust and anything, unless and otherwise there are other specific objectives.
Okay, wonderful. I think we're done with the questions, ma'am. I believe your knowledge was very, very nice, that everybody has definitely delighted to had it. So this was our first session, and it's proud privilege to announce that we had more than 550 participants who registered for this event, and they had taken the wonderful knowledge from you. Now we have our second session. Welcome Jignesh Parikh sir on behalf of ICAI committee. Now we have our second moderator, CA Bhumika Mudraji. So yes,
you.
Bhumika ma'am, over to you.
Yes,
Please take
thank
the
you.
charge.
Thank you, madam.
Yeah, thank you.
Good afternoon, everyone. I am CA Bhumika Mundra, moderator for this webinar. We are delighted to welcome our second speaker, CA Jignesh Parikh ji. Our session will be is on topic taxation of stock market transactions. CA Jignesh Parikh ji just completed his law and now applied for the Sanad. His main area of interest is direct taxation litigation. He has delivered many lectures on the various areas of direct tax. Over to you, Jignesh sir, and I hope you all have a great learning.
Thank you very much, Bhumika ma'am. The Honorable Chairman and the entire Managing Committee of CPE Committee, ICAI, the moderators, my co-faculty for the day, and other participants. It is indeed a matter of pride and privilege to deliberate with you on this important and interesting aspect, that is stock market transactions. Now, we would divide this topic into few parts. The first one being whether it would be a business income or it would be a capital gain, meaning that the first part is what would be a tax treatment if it is treated as business income, and what would be a tax, and the second part would be what would be a tax treatment if it is treated as a capital gain. Then we will deal with certain issues as well relating to the same. If anybody has any questions in between, you are absolutely free to interrupt me in between, and definitely we will deal with those questions as and when they come up. Or if the moderator advises otherwise, meaning that we can give the questions at that, I am comfortable both the ways. Now, let us start our discussion. The first issue which comes is whether the income is going to be taxed as income from dealing in stock market. Now, dealing in stock market, when we say, it can be a share transaction, it can be a derivative transaction, or it can be a dividend income. Now, whether this particular income, which I may have in a delivery-based transaction or a derivative transaction, will that be my business income or capital gain? Now, it was a ting-tong battle going on between the department and the assessee. The controversy has been put to silence by CBDT by coming up with the circulars and instructions from time to time. We have circular number 6 by 2016 and instruction number 2 by 2016, which says that if I have got income from delivery based transaction, I mean, I have traded into the, or I have dealt into a delivery based transactions. Now, if I offer them as business income, revenue will accept it without putting it to any dispute. So if I offer them as a business income, there's nothing to be bothered about. We talk about only listed shares right now. I'll come to unlisted shares in a little while from now. So far as I propose to offer them under the head capital gain and assume that the capital asset are held by me, assume that it is a long-term capital asset, because in case of a listed shares, we know that the period of holding is 12 months. So in case of a listed shares, if they are held for a period of more than 12 months, so they are long-term capital assets. And if I offer this gain, that is a long-term capital gain to tax as long-term capital gain, and if I comply with one condition, that I maintain consistency, if that condition is being followed, then even that long-term capital gain will not be put to dispute. Now the issue comes is, what would be a case if the shares are held for a period of less than 12 months? If the shares are held for a period of less than 12 months, then they might be a short-term capital gain or a business income. Now it would depend on facts and circumstances of the case. So here, what the factors would play important role? The multiplicity of the transaction, magnitude of the transaction, period of holding, how frequently I have traded into that. So all those factors would be decided, would go and decide whether they are going to be my business income or a capital gain. Similarly, what I have done in the past. So how did I dealt with those transactions in the past? What if I'm maintaining my books of accounts, and what is the treatment that I have given in my books of account? Whether I have used borrowed money to deal into the shares, or I have used my own money, all these factors will cumulatively decide whether it would be a business income or capital gain. So to summarize in a very simple way, I can say that, let's say I have used a borrowed fund, and let's say I buy a share today and sell it day after tomorrow within 3 days or 4 days. And if this is found to be a continuous activity, because sometimes we go to the demat account of the clients and then we download the demat accounts, download those transactions, we find that there are series of transactions, maybe running into 200, 300 transactions. And if we see that what is the period of holding, roughly the period of holding is 3 days, 4 days, or sometimes period of holding maybe 15 days or not even a month, then there are bright chances that it may be held as a business income, because you are not acquiring those shares with an intention to invest into those particular shares, but the intention is otherwise. Intention is to just trade, and when the intention is to trade, it would be a business income only. Similarly, let's say I have borrowed money. Let's take an example. I mean, we are aware that now certain professionals are being given very easy loans. And let's take an example. They have bought the loans. They have borrowed money, and that particular money has been used for the purpose of dealing into the shares. Now, it is difficult sometimes to establish that the one would use a borrowed money for the purpose of investment. Of course, there are other contrary judgments also available, where a view has been taken simply because I have borrowed money. That cannot be the only ground which decide that it wouldn't be a business income. So let me give you an example, and this is my individual view. Let us take an example that market has crashed. I believe that there are going to be a great opportunity, and I would be getting a good amount of gain if I stay invested for a little longer period, and if I acquire shares now. So I borrowed money. I might be paying some interest, maybe 8%, 10%, 12%, but I believe that it would be a good amount of return that I would be getting. I invested into the shares. Then simply because I have borrowed money, that is the only factor that goes against me. But if you look at otherwise, that I acquired those shares, these shares are held for a reasonably a longer period of time. It is not the case that I'm regularly trading and doing, and at every simple price fluctuation or price reduction I acquire and sell. If all those other factors are not there, then there are chances that the judiciary may take a view that ultimately, yes, because I found a better investment opportunity, so I acquire. So it is something like that. If I find some real estate property, I buy a real estate by taking a loan. Then simply because I am taking a loan to buy my house or real estate, it doesn't become my stock in trade. Same ratio may become applicable over here. So there cannot be a hard and fast rule. So far as the shares which are held for a period of less than 12 months, it all depends on the facts and circumstances of a case. There are certain tribunal decisions where also a view has been taken that if the shares are held for a period of less than 1 month, then it will be treated as business income, and 1 month to 12 months will be treated as a short-term capital gain. So it all depends on facts and circumstances of the case. Now coming to certain issues which are relevant. Let's take the first one. We spoke about, now we will deal with the other issues one by one. The other issues, now we talk about the delivery based transaction and how they are going to be taxed. Will they be taxed under capital, under the head capital gain or a PGBP? We spoke about that. Now, if they are going to be taxed under the head profits and gains of business and profession, if that be the case, then ICDS 9 would be applicable. Of course, I'm aware that income computation and disclosure standards are applicable to all assessees other than individual and HUF who are covered by tax audit. And if they are maintaining books of accounts on mercantile basis. So in case of an individual and HUF, they are not maintaining books of accounts on mercantile basis, or in case of individual and HUF who are not covered by tax audit, then obviously the income computation and disclosure standard would not be applicable. Now, if we go by this particular income computation and disclosure, if we go by this ICDS 9, then they say that how to tax the gain. Now, normally what used to happen so far, that we used to compare, let's say, the market value of my cost of a particular share. Let's say I acquired a share of TCS, let's say for 3,800 rupees. Now, right now, the market value of those particular shares is only 3,400 rupees. So I will say that cost or NRV 38, 34. So I'll reflect this as 3,400 rupees generally. This is what we used to do. Now, ICDS says that this is not to be done. You have to put all your listed shares into one particular basket. And what has to be done is, in case of the shares, let's say the TCS, I would have acquired, let's say, for 3,200 rupees, right? 3,800 rupees. Let's say there are 10 shares. So 38,000 is my cost. My market value is 34,000 rupees. I had acquired, let us take an example, Tata Motor might be at a price of, let us take an example, 350 rupees per share. Again, I acquired those particular shares for 1,000 shares. So it will be 35,000 rupees. And the current price is, let's say, 600 rupees. So the price is now market value 60,000. They say that now make a total. So 38 plus 35, that is my cost total, which would be 38 plus 35, that would be 73,000 rupees. Here, if you look at that particular, the market price is, let's take an example, 32,000 rupees and 60,000 rupees. So it was 92,000 rupees for TCS and Tata Motor. So this 73 is going to be compared with 92, and now whichever is less, 73. Now the 73 is going to be my value of inventory. That's what ICDS talk about. ICDS 9, they talk about. So this is what one has to keep in mind while valuing the while valuing inventory when you are offering your business income. Offering income from delivery based transactions, delivery based share transaction under that profits and gains of business account. So far as the capital gain is concerned, we are aware that it is either going to be taxed under section 112A, or it may be taxed under 111A, or it can be taxed under section 112. Meaning thereby, if I am dealing into the listed shares where I have paid STT both at the time of purchase and sale, it would be falling in section 112. So long-term capital gain, STT paid both at the time of purchase and shares, and if it is the capital asset is an equity share or units of an equity oriented mutual fund which are listed on a recognized stock exchange, then it would be covered under section 112. Of course, the exception to that rule is that the consideration is received in foreign currency and the stock exchange is there in the International Financial Service Center, that is our GIFT city. That would be the case. Then in the last condition, that STT wala condition, even if it is not met, then it would be perfectly fine. But then it would be taxed under 112A, where an income, the gain exceeding 1 lakh, that is going to be taxed. If you go to section 112, it says that the capital gain is going to be 20%. Of course, there is an option given to the resident in case of sale of an equity shares which are listed on a stock exchange. Either I pay tax at the rate of 10%, but then I don't claim indexation, or I pay tax at the rate of 20% and I claim indexation. So it is up to me, I can decide. So meaning thereby, let's take an example. I have got 1,000 shares of Reliance. Let's say I bought those particular, I have got 10 shares of Reliance. I'm sorry. Let's say I bought it at 2,500. So let's say the 25,000 rupees is my cost of acquisition. Now let us take an example. The current market price of the shares is, let us take an example, is 3,000 rupees per share. So it is going to be 30,000 rupees. Now, if I sell those shares at 30,000 rupees on the floor of the stock exchange, I acquired shares, I paid STT when I acquired shares, I have paid STT when I'm selling I'm selling this particular shares. I hold this for a period of more than 12 months. Obviously, it will be taxed under section 112A. I'm aware that in this example, it is only 5,000 rupees. Let us take an example, it is 5 lakhs of rupees. Up to 1 lakh, it won't be taxed. The remaining 4 lakh will be taxed. But then let us wait for a minute. Let us assume that in this example, let us assume that my gain is 5 lakhs. I acquired for 25 lakhs of rupees. I sold it for 30 lakhs of rupees. So my gain is long-term capital gain is 5 lakhs. Now I acquired another residential house. So I'm going for section 54 and benefit. Now I acquired that another house. Let's take an example for 12 lakhs of rupees. Sorry, I acquired that particular house, let's say for 1 crore rupees. So since my full value of consideration, entire full value of consideration is invested because it was 30 lakh, I acquired for 1 crore rupees. So my entire 5 lakh capital gain would be exempt. The issue is only 5 lakh would be exempt, or I would say 4 lakh would be exempt. 4 lakh is exempt and 1 lakh over there. No, entire 5 lakh capital gain is going to be exempt over here. And now nothing will go to section 112. Let me give another example of a similar nature. Let us take an example. I have sold certain shares. Let's say that we are aware that the short-term capital loss can be adjusted against short-term capital gain or long-term capital gain. So I have got a short-term capital loss, let's say of 5 lakhs of rupees, and I have got long-term capital gain covered under 112A 5 lakhs of rupees. So I'm adjusting this short-term capital loss with the long-term capital gain 5 lakhs of rupees. If I say that no, I will adjust only 4 lakh, 1 lakh I would carry to 112, and this 1 lakh short-term capital loss I will carry to the next year. This is not allowed. Sections are to be given effect in its sequence. So what would happen is that, let's take an example. In my case, 5 lakhs short-term capital loss, long-term capital gain 5 lakh, entire short-term capital loss will get adjusted with the long-term capital gain of 5 lakhs. Nothing will be with me, and nothing will travel to section 112. That's what I wanted to highlight. Now coming to unlisted shares. Now, if we talk about unlisted shares, what is going to be the tax treatment in case of unlisted shares? Now, in case of unlisted shares, the position is very clear. Unlisted shares are not freely tradable. There is no open market available for trading them. When there is no open market available for trading into an unlisted shares, there cannot be a situation that unlisted, if I deal into the shares of if I deal into the unlisted shares and they are being held as business income, because there is no free market. So when there is no free market available, obviously I cannot acquire those shares with an intention to trade. That is practically not possible. So whatever unlisted shares, equity shares I have traded into, it is going to be my capital gain only. So that has also been clarified. Coming to the last, which is a dividend income. Dividend income is always taxable under the head income from other source. Now in the return itself, but they also provided, they have made a change and they have provided that in case of capital gain, that is also going to, in case of dividend, it is always going to be taxed under the head profits and gains of business and profession. Even if, under the income from other source, even if it is my business to deal into the stock market, even if it is my business to deal into the stock market, it would be taxed under the head, it would be taxed under the head income from other source only. Now that leads me towards a question. Let us say that I have got a business loss in year number 1. In year number 2, I have got a dividend income. So far as I have got dividend income in year number 1 itself, there is no problem. Year number 1 में अगर मेरा dividend income है, there is no problem. Business loss can be adjusted with the dividend income from other source. There is no issue. But now the problem is that I have got business loss in year number 1. So it is a brought forward business loss. Now in year number 2, I have got income from other source. Now the question is, can this particular business loss be adjusted against this particular income of dividend, which is taxed under that income from other source? Now, please note that though this particular income is taxed under the head income from other source, only the act decides what act decides the head under which this particular income can be taxed. Act cannot decide the nature of the transaction. The nature of the transaction by itself is a business income. Since it is a business income only, it would be able to, so my loss from the business head can very well be adjusted against the dividend income, and it is allowed to be set off, and that is this is absolutely permissible. There is no issues on that, and we have got a direct judgment on this, and that is in the case of, that is by Honorable Bombay High Court, in the case of the Manali trading, where similar view has been taken, meaning thereby one can apply the similar ratio when I say that I have got a short-term capital gain from the sale of the depreciable asset. So it is only for the purpose of taxing it, it has been classified under the head capital gain, short-term capital gain from the sale of the depreciable asset vis-a-vis the past year's business loss. That can definitely be adjusted because by nature it is basically a business income, and obviously this can be set up, and this view has been taken by the Honorable Bombay High Court in the case of the Manali trade. Now that takes me to the third category. So the first one we spoke about is the delivery based transaction. Within that we spoke listed, unlisted. Second, now we spoke about, we also spoke about the dividend. Now we are going to discuss about the derivative transaction and the intraday transaction. Now, the question that first comes is that the derivative transaction, will this derivative transaction be a business income or income from other source? Now, now the definition of business is trade, manufacture or commerce, or adventure in the nature of trade, manufacture and commerce. Meaning thereby, even if I am doing one particular transaction, which is precisely an adventure, that would also fall in the definition of business. Since it would be a business, it would be taxed under that business and profession. Some of the people may sometimes take a view that it is to be taxed under that income from other source, but then it may invite some litigation at a time to come, because it may, I mean, as a matter of fact, it won't have, if it is a one odd transaction, it will not have exact, I mean, financial impact, because it is a business income or income from other source will not make a difference, because in both the cases, the income would remain the same. And rate of taxes also effectively would remain the same. The point which I want to cover here is that how to compute here the turnover. The turnover in case of a derivative transaction. So first of all, let us deal with section 43, subsection 5 says that if a transaction is settled otherwise than by way of taking actual delivery, if the transaction is settled otherwise than by taking or giving actual delivery, it would be a speculative transaction. It would be a speculative profit or speculative loss. Now, so far as a derivative transaction is concerned, this derivative transaction in shares or derivative transactions in commodity, they are being settled without taking or giving the delivery. So if we go by this definition, which is given in section 43 bracket 5, they turned out to be a speculative business, or they turned out to be speculative transactions. But the exceptions to section 43 subsection 5 says that if the transaction is executed on the floor of the stock exchange and we have got digitally signed contract notes available so that these conditions are being satisfied, then it would be a business income and it will not be a speculative transaction. I'm talking about derivatives. I'm talking about future and option. I'm not talking about intraday transaction. There is no exception so far as intraday transactions are concerned. If I have bought Maruti Suzuki India Limited shares today and sell it today itself, it is an intraday transaction, buy today, sell today. And in that case, it is going to be a transaction which is settled without taking or giving delivery. Since it is settled without taking or giving a delivery, so it is going to be my speculative business income only. It will not be my regular business. It will not be my regular or a normal business or a non-speculative business. But if a derivative, if I'm satisfied, I met with those conditions, it is going to be my speculative. It will not be my speculative business. The question which really comes is that how to calculate turnover? Yes, we are aware that the guidance note 2022 made one amendment to that definition, how to really compute. We know that in case of the future transactions, in case of an intraday transactions or in case of a reverse trade transaction, what we need to take? We need to take the total of favorable and unfavorable differences. So that total of favorable and unfavorable differences, that would become my turnover. In case of an option, let's say I bought option, I sold that particular option, then I have to take a difference. But if I have only sold an option, let's take an example, and then I have received a premium, then I did not square it off. Finally, the premium value becomes zero. Otherwise, when the entire premium value is being computed for the purpose of computation of the profit, and in that particular case, that entire premium amount would fall into the definition of my turnover. That's how the turnover is required to be calculated. The question next is the implication of ICDS. What would be the impact of ICDS? Can there be a losses, mark-to-market losses, and will that be allowed? Now, if you go to ICDS 1, they say that the mark-to-market losses will not be allowed unless otherwise specifically provided. If you go to ICDS 2, which is dealing with the inventory, because now this Reliance future or TCS future or Wipro future is going to be my inventory. Now, ICDS 2 would be applicable. ICDS 2 says that we would be applicable to the inventory, but then there are certain exceptions, and one of the exception is to those items which are being covered under ICDS 9, ICDS 8. I'm sorry, that is securities. Now, if you go to ICDS 8, they say that securities are being covered, and how to value securities, that is being covered in ICDS 8. Then they define the term security. Security shall mean the securities definition is given in Securities Contract Regulation Act under Section 2, but we will not include derivative. Meaning thereby, derivative is given go by. Look at a situation. ICDS 2, see, the first thing is that I have got Reliance future on 31st March, that is my inventory, that is for sure. The question is how to value the inventory. I will go to ICDS 2. ICDS 2 says that inventory are to be valued at cost or NRV, whichever is less. But this ICDS will not be applicable to those securities which are being dealt with by ICDS 8. So because this derivative falls in the definition of security as per Section 2 of the Securities Contract Regulation Act, I went to ICDS 8. ICDS 8 says that the security, we will deal with the valuation of securities, and all those securities will be covered which are referred to in Section 2, but derivative will not be covered. So once again, my derivative F&O will not be covered. So I'll fall back, in my opinion, to ICDS 2. And once again, the inventory is to be valued at cost or NRV, whichever is less. And since it is to be valued at cost or NRV, whichever is less, in my opinion, one can still take the benefit of mark-to-market losses. So though ICDS 1 is technically said no, you cannot, but then if we put it this way, then probably still we have a case where we can say that the benefit is available. Once again, the judiciary may have their own, they may not agree with my views. This is my interpretation that ICDS 2 might be applicable in this particular. That is another point which I wanted to discuss, that is with respect to derivative. So far as intraday, as I mentioned, it is going to be a speculative business only. One more thing, applicability of Section 44 AD. Section 44 AD is applicable to an eligible assessee carrying on eligible business. So if the assessee is an eligible assessee doing an eligible business, of course, Section 44 AD would be applicable if the other conditions are being satisfied. So if the case falls in Section 44 AD6, for example, I have got a commission income, or let's say if I am a professional covered under Section 44 AA, or if I have got an income from an agency business, obviously 44 AD will not be applicable to me. So let's take an example. I have got a commission income of 5 lakhs of rupees, and then 44 AD will have no applicability to me. Now I can have commission, I can offer my commission income on cash basis or mercantile basis. In case of a chartered accountant, 44 AD will have no applicability, because they are professionals. But then mind it is applicable, in my opinion, 44 AA is applies to a professional. And when we talk about professional, chartered accountant, to my mind, who is in practice, if he's in industry, is getting employed, he's getting a salary income, this may not be a situation over there. So if you are a doctor and getting a salary from a hospital, no. But then if you're a doctor getting salary, also you are carrying on your own profession, then 44 AD will not be applicable, because you are a professional covered under Section 44 AA. But then if you are a kirana store, if you are a trader, if you are a businessman, then definitely, and if you meet with the other conditions, then you become an eligible assessee. 44 AD would be applicable to you if it is a 44 AD applicable. And then 44 AD talk about eligible business. Eligible business means all business where the turnover does not exceed 2 crore rupees, and the business is not of the nature which is referred to in Section 44 AE, so that is leasing and hiring of the hiring the vehicle wala business 44 AE. So if you are not falling in that particular case, then obviously this would be an eligible business where you have to calculate your turnover. If the turnover is less than 2 crore rupees, then 44 AD would be applicable, and you have to show the profits accordingly. So that is to be taken care of. So with this, we spoke about intraday. Intraday, once again, eligible assessee doing eligible business. So the point is that intraday is also an eligible business. The eligible business do not exclude from that category, or they do not distinguish between a speculative business or a non-speculative business. It could be a speculative business, it could be a non-speculative business. So anyway, we are not further deliberating on particular part of 44 AD, but then what we are trying to cover, what we are going to discuss here is that eligible assessee doing eligible business, and the eligible business excludes only those business where turnover exceeds 2 crore, or if the business is of the nature referred to in Section 44 AD, then only it won't be covered. Otherwise, it would be covered over here. So if it is intraday, or if it is a speculative transaction, if it is in that particular case, 44 AD would be applicable if the assessee falls in the chapter of profits and gains of business and profession. So we spoke about delivery-based transaction. We also spoke about intraday. We spoke about derivatives. We spoke about tax treatment in case of dividend, that under what rate it can be done. Now let us deal with certain issues which might be of relevance. Let us take an example. I acquire shares of a company, let's say on 12th of July 2022. I sold that particular share on 11th of July 2023. That is yesterday. It is of course going to be a short-term capital gain because I should have held the shares for the entire period of 12 months. Now, if I bought the particular shares, if it is up to 12 months exactly, it would be a short-term capital gain. Let's say I got the shares, listed shares on 12th of July 2022. I sell it on 12th of July 2023, that is today. Would it be a short-term capital gain or it would be a long-term capital gain? Meaning thereby whether the day on which I am selling the shares, whether that is to be included in computation of my number of days or not, that is the issue which we are discussing here. We have got a direct judgment of Honorable Delhi High Court in the case of the Bharti Ramola Gupta, where a view has been taken, where the Honorable Delhi High Court has held that it is going to be taxed. It would be treated as a long-term capital gain. Part of the day is also required to be, it is required to be taken into the consideration. So of course, this is a part of the day and that is required to be taken into the consideration. Going to the next issue. We spoke that in case of derivatives, in case of derivatives, let's say section 43 subsection 5 comes to my rescue. They say that if there is a derivative transaction where the conditions are being satisfied, it will not be treated as a speculative transaction. So far as individual is concerned, there is no problem. The question that really comes is in case of corporates, where section 73, explanation to section 73 falls. So unless a company fall into the agony of the exception given into the explanation to section 73, then if the company does not fall into the exceptions given, like it is the business of the company to dealing into the shares, or the company the company is an investment company and the other conditions, if they fall in any of those particular exceptions, then no problems. Otherwise, whatever income that they get from dealing into or trading into the shares, that is going to be the speculative business. The question that now comes is, what would prevail? Section 43(5) would be would prevail, or explanation to section 73 would be applicable. Now, I am not here trading or dealing into the shares. I am dealing into the derivatives. What should be the case? Judiciary has been divided here. We have got a view of Delhi High Court in case of DLF commercial, where Honorable Delhi High Court has said that the derivative derive their value from the shares only. So definitely, in case of the company, it would be a speculative business. Explanation to section 73 would be applicable and triggered. However, fortunately, we have got a judgment in case of the Calcutta High Court, where the Lordship did not agree with the view given by the Honorable Delhi High Court, and we have got the judgment in the case of the Asian Financial Services Limited, 76 Taxman.com 9, Calcutta High Court, where a view has been taken that it would be a business income only. Section explanation to the matter would be covered by section 43 subsection 5 only, and it will not go to explanation to section 73. We have got Ahmedabad ITAT on the similar line, Magic Share Trader as well. Now this leads towards a question that if I am dealing into the commodity derivative, would explanation to section 73 would be applicable? Anyway, now since we are very clear that even if it is a share derivative, it won't be covered because we have got the direct decision in the case of the Calcutta High Court, in the case of the Asian Financial Services. So certainly in case of commodity, it should not be applicable, but then still we have got a direct judgment of the Honorable Madras High Court in the case in the case of in the case of Sri Wasabi Gold and Bullion Private Limited, 92 Taxman 290. The Madras High Court has given a direct the direct judgment on this. They say that the commodity are not the shares, so there is no point looking towards explanation to section 73. So this is a second point which I wanted to deal with. Now that leads towards a second issue to me. Another issue here we want to deal here, another important point that I wanted to cover here is section 56 subsection. Or before I go to 56 subsection 2, let me deal with one other issue, that PMS. Generally, we go with a PMS, that is a portfolio management scheme. And if you go to a portfolio management scheme, we give our shares to the we give the funds to the portfolio manager, and the portfolio manager then they go and manage our portfolio. If they go and manage our portfolio, we have got the gain or loss on that. Would it be a business income or a capital gain? Once again, the judiciary has been divided here. Bombay ITAT, Pune ITAT has taken a view that it is going to be a capital gain because their aim is to maximize the wealth and everything is being taken care of by the PMS. But unfortunately, Ahmedabad ITAT has taken a view that it is going to be a business income. In that case, there were numerous transactions executed by the portfolio manager. That's what it has been observed by the Ahmedabad ITAT. So one can once again make a case taking a view that this case may be differentiated on the ground that there are numerous transactions. The transactions are, but here the transactions are being taken. Transactions are not being executed by the assessee. He has no acumen of or no time of dealing into the shares. So he has appointed a professional, that the professional is doing that particular business only, and the activity is being carried out by the professional only, and it has to be treated as a business. So once again, as I mentioned, the Pune and Bombay ITAT have taken a view in favor. The Chandigarh ITAT has also taken a view in the favor, but unfortunately, the Ahmedabad ITAT has taken a view that it would be a business income only. Now with this, I go to the another issues, that is going for section 56 subsection 2. They talk about valuation. Now if we deal with that, whether section 56 subsection 2, let me first go to the section itself, which will make the things little easier for us to now. Section 56 subsection 2 clause 7b provides that where a company not being a company in which public are substantially interested receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of such share, the aggregate consideration received for such shares that exceeds the market value of that particular shares, that is going to be taxable under the head income from other sources. So now the question is, to whom this section would be applicable? This section is going to be applicable to a company not being a company in which public are substantially interested. So if there is a company which is in which public are substantially interested, meaning thereby, let's take an example, if we talk about a listed company, then these provisions are not going to be applicable to them. So when a company not being a company in which public are substantially interested in any previous year receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of such share, the aggregate of the consideration so received for such shares as exceed the fair market value. The question is whether this would be applicable only to an equity share, or it would be applicable to preference share as well. Now, if we look at the language is very clear that when a company not being a company in which public are substantially interested in any previous year receives in any previous year from any person being a resident any consideration for issue of shares. They use the word issue of shares. Once the word issue used here is issue of shares, what is going to be covered here? What is going to be covered here? Both equity share as well as preference share. That leads towards a question that how they are going to be then valued. So for valuation, I have to go to Rule 11 UA. Now, if you go to Rule 11 UA, sub-rule 1, sub-rule 1, clause C, and within clause C, we have got one more clause. So clause C of clause C of subclause C of sub-rule 1 of Rule 11 UA reads this wise: the fair market value of unquoted shares and securities other than equity shares in a company which are not listed in any recognized stock exchange shall be estimated to be the price it would fetch if sold in the open market. So if we read that rule, they say that the fair market value of unquoted shares and securities other than equity shares in a company, meaning thereby it deals with the preference shares. So if there are preference shares, the value is to be decided according to the rule 11 UA sub rule 1. Within that sub rule 1, clause C and then the C of that clause C. And once again, please note that here it is not necessary that this valuation is to be done by a merchant banker. It can very well be done by a chartered accountant. So chartered accountant is not ejected from here. Here it can be very well be done by a chartered accountant. In practice, the fair market value of unquoted shares and securities other than equity shares in a company. So obviously, it is going to be a preference share. That is what they are going to discuss here. I mean, the preference shares would be covered over here in a company which are not listed in any recognized stock exchange shall be estimated to be the price it would fetch or sold in the open market. So how they would decide the price at which they would fetch if they sold in the open market, the valuation standards are to be prescribed. I am not a man of valuation, so I cannot comment on it. But what my aim here is to discuss that a chartered accountant can very well carry out the valuation under this under this category as well. So far as the fair market value of unquoted equity shares is concerned, then yes, it can be done under clause B, subclause B of clause C of subrule 1 of rule 11 UA. And then we know that there is a formula available. So the fair market value of an equity share shall be the value on the valuation date. So that is how that particular value would be decided here. So this is what I wanted to cover. Now we have one more section that needs to be dealt with, and that particular section is section 50C. Section 50. Section 50 deals with a situation. Section 50 CA, my mistake. Section 50 CA. Now, Section 50 CA is a special provision for full value of consideration for transfer of shares other than quoted shares, meaning that it won't be applicable to a quoted share. So they say that when the consideration received or accruing as a result of transfer by an assessee of a capital asset being shares of a company other than quoted shares is less than the fair market value of such shares, meaning thereby it is absolutely in line with what we have in section 50 CA. We are aware that in case of section 50 CA, if I'm selling an immovable property, like being a land or building, and if it is sold at a price less than the gentry value, then subject to certain exceptions, the gentry value would become my fair market. That value would become my full value of consideration. So similar way, we have got section 50 CA. If I'm dealing into the shares of a company, we are not listed on a recognized stock exchange, they are not quoted. And if I sell it at a price less than the fair market value, then this fair market value would be. And how to calculate the fair market value? I have to go to once again rule 11 UA to calculate that particular fair market, to calculate this particular fair market value. The point here is it is applicable only to shares which are not quoted on a stock exchange. Meaning thereby, let us now take a question. Let us say I have got a shares of Reliance. My Reliance share I acquired, let us take an example at a price of 2,500 rupees. I acquired one share at a price of 2,500 rupees. Current market price of this particular share is, let us say, 3,000 rupees. Let us say I sell those shares for 3,500 rupees. If on stock exchange, I cannot sell it for 3,500 rupees, but then I sell it to somebody off market 3,500 rupees. What would be a situation? I can sell those shares at 3,500 rupees. My gain would be 1,000 rupees. I will not be covered by section 112A because the condition is that the shares should be a listed. It should be a list. It should be a share listed on a stock exchange. STT should be paid both at the time of purchase and sale. I'm not complying with that particular condition. It may be a long-term capital, but I'm not complying with that condition. Now what would happen? I'm selling it at 3,500 rupees. Somebody is acquiring it at 3,500 rupees. Market current price is 3,000. I would have again, I will be given asked two questions. I'll be falling in 112. 112 says that if you are selling an equity shares which are listed on a stock exchange, then I'll be given a two option that either the long-term capital gain can be taxed at the rate of 10% if I don't claim indexation. So let's say I don't claim indexation. It will be taxed, this 1,000 rupees is going to be taxed in my hand at the rate of 10%. Now these shares are acquired by somebody at 3,500 rupees. The gentleman who acquired the shares off market from me at 3,500 rupees, he feels that, oh, he has committed a mistake by acquiring those particular shares at 3,500 rupees. Now he goes to a market and sells those shares for 500 rupees. It would be a short-term capital loss in his hand. Number one. Number two, let us take an example. I bought a share, let's say for 2,500 rupees. The market price of that particular share is, let's say, 5,000 rupees. I sell this particular share off market to someone, let us say at 3,000. Now, in the first example, when the market price was 3,000, I sold it 3,500 rupees. There was no problem. If the someone may be related, may not be related, will really make no difference to me. Of course, if the one can take an extended view that if that other person is not related to me when I sold the shares of 3,000 rupees for a price of 3,500 rupees, and he's not related to me, no worries. But if he's related to me and that gentleman is falling into the business side and now he has acquired the shares at 3,500 rupees and acquiring from a related party for a price more than the fair market value, 48 UB would be applicable. It would be a different issue altogether. Then yes, I mean that would be a different case. But let us take an example. Now I am dealing with a situation when the fair market value of the shares is 5,000 rupees. I acquired for 2,500 rupees. I'm selling, they're listed shares. I'm selling it for 3,000 rupees. Now the other party may be a related. Now the other party may be a related party, or the other party may not be a other party may be a related party. Other party may not be a related party. We'll deal in both the first. If the other party is a related party, sorry, if the other party is, let's say, not a related party. If the other party is not a related party, then what would be a situation? In that case, I am selling it for 3,000 rupees. 50 CA will have no role to play because 50 CA would be applicable if the shares are if the shares are one minute. Let me go back to this section where the consideration received or accruing as a result of a transfer by an assessee of a capital asset being a shares of a company other than quoted shares. So I'm sorry, the shares are quoted shares. So 50 CA would be applicable. Sorry, I was about to take a different view, but then once again I read it and I'm sorry, the view would be different, whether it would be a related or it would be an unrelated. So let's take an example. 5,000 rupees shares is a listed on a stock market. So the shares are quoted. So 50 CA will have no applicability over here because the shares are quoted shares. So 50 CA won't be applicable. I am selling it at 3,000 rupees. Nothing would go wrong against me. Only 500 rupee profit in mind. 50 CA will have no applicability because the shares are quoted shares. If the shares are quoted shares, no problems. If I go to sell on the market, it will be sold at a 5,000 only. But I'm not selling on market. I'm selling off market, so it will be 3,000 only. So nothing will go wrong so far as it is not a related party or a related party. To me, nothing will go wrong. I am comfortable. Now, so far as the recipient, if the recipient is a related party, he is my relative as falling in section 56 subsection 2 clause 10, which deals with gift. So if that is my relative as defined over there, in that particular case, once again, there will be some, in that particular case, there will not be a tax treatment in his end. But if the gentleman is not related to me, section 56(2) clause 7 would be applicable. And in that particular case, sorry, 56(2) subsection 2 clause 10 would be applicable. In that particular case, it would be taxed as gift. In that particular, it will be, there'll be the differential amount, that is 2,000 rupees, because he's acquiring something at a price less than the fair market value, and assume that he falls in the case where the difference exceeds 50,000 rupees. Then definitely in that particular case, the 56(2)(10) would be applicable, and in that it would be taxed under the head income from other source. That 2,000 will be taxed income from other source. Of course, when he is selling those shares, ultimately the cost of acquisition will become 5,000 for him. So these are the points which I wanted to cover. I would just ask a quick question. It is 5:05. Should I'm already overshooting my time, so should I continue how it is?
Sir, 5-10 minutes will be okay.
Fair enough. Okay. So now another issue that quickly comes is the buyback of shares. Recently, we have experienced a situation of a buyback of shares. What would be a tax treatment in case of a buyback of shares? If it is a buyback of shares, and if the conditions of Section 115 QA are being met, then it will not be taxable in the hands of the shareholders. So Section 1034A rate with Section 115 QA, it won't be taxable. So let's say the Wipro ke jo shares the, if somebody has given those shares in the buyback, they have got a profit. Let's take an example, and those profit will not be taxable to them. This would be straight away taxable to the company. Now let's take an example. The shares were issued at 10 rupee originally. I had acquired those shares for 60 rupees. The buyback is, let's say, at 80 rupees. Now the 20 rupee will not, because I acquired for 80, my cost was 60, 20 will not be a profit in my hand. But certainly this particular amount, but it would be taxable to the company, and the company would be the 70 rupees, 80 minus 10. That 70 rupees will be taxable in the hands of the company. Now let us take one more situation. Let us say the current market price of the share, the fair value of the shares is, let us say fair value of the shares is, there is a buyback of the share. Buyback of the share has happened, and let's say the fair market value of the particular shares is, let's say, 100 rupees, and the buyback took place at 70 rupees. So when buyback took place at 70 rupees and the fair market value is 100 rupees, so if we talk about Section 56 to 10, right? So in that case, will there be a tax treatment? Now we precisely deal with this issue from the situation of a company, because in case of a company, the fair market value is 100, they receive it, then they buy it at 70 rupees. Will the 30 rupee be taxable to them? The point is that there should be a receipt. What do the company actually receive? The moment the shares come to them, they are being extinguished. The moment the shares are being extinguished, they are no more their asset, and they are not receiving anything. And to be covered under Section 56(2)(10), receipt is sine qua non for being covered under Section 56(2) clause, and that condition is not being met. So in my opinion, that even in that case, the 56(2) will not have any applicability to them. So I have almost dealt with all the important issues to my mind, which I should have covered. Of course, it is a very detailed topic. We can otherwise talk for a little longer time as well. But then keeping in mind the positive, that we have dealt with almost all the relevant issues. If any member has any specific query, it would be a pleasure to deal with that. I really enjoyed deliberating here. If I have said something which anybody has felt being hurt, I really convey my apologies for that. Over to you.
Thank you so much, sir. There is a few questions.
Please, ma'am.
Question 1. Stock allotted by Singapore company under ESOP to the resident employee. When ESOP has sold, TDS was deducted by employer under Section 192. Will capital gain, short-term or long-term, be taxable under Section 192 or under capital gain?
So it is always going to be a capital gain. 192. See, when you are being allotted ESOP, understand the point. Let's say the fair market value of the share is 100 rupees. You are being allotted shares, let's say, at 60 rupees. So the 40 rupees is going to be gain. That 40 rupees will be taxable to you as under income under the salary. Now, once again, 2 years back, there is an amendment over there as well, because what happens is that keep 40 to, okay, I'm sorry, the 40 rupees is going to be a gain, but then you are not having a liquidity to pay right now. So there are certain conditions which are given over there, that if you quit a company, if you sell a share, or certain number of years are being expired, if any of this event triggers in that particular year, it would be taxable, and TDS is also to be deducted in that particular year. Be it as it may, but then 40 rupee will be taxable as salary, because fair market value is 100. You are given an option to buy it at 60. You bought it at 60. So the 40 rupees salary. Now, when you are selling it, let's say at 180 rupees, this 80 rupees is going to be, assuming the other conditions are being met. So 80 rupees is going to be the capital gain. So 180 minus 100, not 180 minus 60, because 40 has already been taxed as salary.
Second question. If derivative on exchange platform is settled on intraday basis, it will be normal business or speculative business income?
No. So basically, it would be a derivative only when you they are not given, the exception does not have any kind of a situation that it is done. It is to be settled in a day or other. If you settle in a day, or you may settle, let's say, in 15 days, doesn't make a difference. It would be, in my opinion, it would be a derivative only. Intraday, we are saying it is covered, madam. We are saying intraday is a speculative, because there is intraday का कोई exception नहीं है वहाँ पर. There is no exception of intraday over there. So that is the precise reason we are saying that intraday is not covered.
We have another question. If LTCG from listed share is 4 lakhs, short-term capital loss from listed share is 50,000, and also purchase of house property is there for 8 lakhs, then will 50,000 loss will be first adjusted from LTCG?
So first of all, you have to calculate the capital gain. Capital gain would come under section 45. So section 45 says that the gain arising from a transfer of a capital asset. So the gain arising from a transfer of a capital asset, that needs to be calculated. So the first you have to adjust this 50,000 rupees, and then you have to go to sections are to be applied. I mean, you calculate capital gain first. You calculate capital gain first. That capital gain is 4 lakh minus 50,350, and then you go to the 54 wala section.
Okay. One more question. Could you please explain taxation of off-market transactions?
So yes, so basically, let's take an example. Number A, I mean, we have dealt with this issue, but then quickly revising that, if it is an equity shares not listed on a stock exchange, so in that case, there is no effective market. Since there is no effective market, it is going to be taxed under the head capital. It is going to be taxed under the head capital. It is going to be taxed. It is going to be taxed under. It is going to be taxed under the head capital gain. It is going to be taxed under the head capital gain. It will not be taxed under the head profits and gains of business and profession. Since the shares are not, I mean, now let's take an example. The shares are listed, but you are dealing into an off-market transaction. Then 112 to a resident gives you an option. Either you want to be covered. Let's say you want to be covered by tax at rate of 10%, or you want to be covered by 20%. So if you want to be covered by 20%, you can take benefit of indexation. If you don't want to be covered by 20%, it would be, I mean, so if you want to take if you do not want to take an indexation, it would be 10%. So let us now extend this particular question to a level ahead. Let us say I got a bonus shares. I have got a bonus shares at a price of and the cost of acquisition of the bonus shares is 100 rupees. Now, if I sell this particular bonus shares, the current market price of these shares is 600 rupees. If I sell this particular shares at a price of 600 rupees, let us take an example in the market, then entire 600 rupees is going to be taxed to me. Correct? And that particular 600 rupees will be taxed at the rate of, I mean, 10%. Correct? So that entire 600 would be taxed at the rate of 10%. Now, if it is actually 112A conditions are being satisfied, let's take an example. If I sell those particular shares off market, then also this particular 600 shares, I will be given two options. A, take an indexation, and 20%, don't take an indexation, 10%. So if I don't take an indexation, still I would have a profit of, because zero ka indexation zero hoga. So ultimately the 600 rupee would be get, it will be taxed at the rate of 10% only.
Okay, one more last question. Assessee having two demat accounts, one for trading and one for investment in shares. Now the assessee is transferring share from business demat to investment demat. On sale of shares from investment demat, what will be the rate of capital gain applicable? As on purchase of shares is purpose of shares is an investment demat. There will be no STT paid.
Correct. So let us discuss this first. Number A, I can have more than one demat account. There is no problem to it. Number two, I can, and as a matter of fact, when you acquire shares for, I mean, when you intend to acquire certain shares for trading, and when you intend to acquire certain shares for investment, and then you are keeping two demat accounts, it is rather a good case, because the intention is very clear from the day acquisition. The dispute would be less, that the investment wala demat would be going into the capital gain, and PGBP wala demat would be going to the business income. But then let us take an example, as you have pointed out in the query, that I have got acquired certain shares. Now I transfer to the investment account. Now it is a question of fact, rather a question of law. Fact in the sense that the consistency provides that demat, let's say with ICICI Direct, is always with an acquire for the purpose of business, but the demat with SBI Securities is always for the purpose of investment. So when I acquired, it was my inventory. I converting my inventory into a capital. The inventory is being converted into a capital asset. So fair market value on the date of the conversion would be minus cost of acquisition would be my business income, and that fair market value would become would become my cost. so far as capital gain calculation is concerned. Now when I'm selling it, so the difference between the sale consideration and the fair market value, which is taxed under the PGBP, that would be my capital gain. Now, if you have paid STT both at the time of purchase and sale, 112A would be applicable. If you have not paid STT at the time of purchase, obviously the 112A would not be applicable. The only point is period of holding will be considered from the date you
Originally purchased.
no, from the date you convert into that particular demat,
Okay.
business to demat. It won't be from the
Business.
original purchase. That is
Okay.
an amendment. Now, also let us take a situation. One step ahead. I acquired those shares somewhere. I acquired those shares. Or I applied for a public issue, and I got the shares in public issue. When I get the shares in public issue, there cannot be an STT. Or if I get a shares by in a merger or amalgamation, there cannot be an STT. If I get a shares by a bonus, there cannot be an STT. So I bought certain shares. 100 shares I had originally bought. I got a bonus shares. Another 100 shares I got a bonus shares. Now I have sold my first 100 shares straight away. My business income, it is clear. Now I got a bonus shares only in my demat. I'm transferring those particular bonus shares to my another demat account. Right? Obviously, the business income would remain business income. There is no issue. Now when I'm selling it, period of holding would also be computed, taking a difference only. Taking that particular period from the day on which it is shifted to the demat account of a capital gain. The only point is here STT payment ki zarurat nahi thi. So even if you are not paid an STT, you can go to the 112 because there is one circular given where they say that in some of the cases, like the STT came from 110-2004. I have got a shares acquired prior to 110-2004 when there was no STT itself. So in those particular cases, even if you are not paid STT, that is okay. If you have got unit of an equity, I'm sorry, I forgot to discuss this. If you got a unit of an equity-oriented mutual fund, and then you might not have paid STT at the time of originally at the time of purchase, then also you can get the benefit of 112.
Okay.
112A.
That's all for the question answer session. Thank you, CP committee, for giving me the opportunity to be a moderator in this wonderful webinar, and would like to thank both the speakers, CA Pooja madam and Jignesh sir, for this amazing session. By this, we will conclude our today's webinar. Thank you all the participants. We have 604 number of participants today. Thank you.